What is going on, traders? Welcome back to the Traveling Trader. Was on vacation for a week, but I'm back now. That's neither here nor there. You are here with me now. That's all that matters. In this video, I do want to go over some important factors that we need to watch out for in the market this week. There is a lot to get into this week from the Fed meeting at Jackson Hole, where we will get to see whether the Fed are actually going to taper asset purchases. We'll talk about what that means briefly. Trust me, this will be beginner friendly. I'm not going to lose any of you. We're going to talk about what happened historically when the Fed has tapered, because this is not the first time that the Fed is making large asset purchases. Actually, they have a habit of doing this. It's called quantitative easing. And we have data on exactly what happened when they started tapering Fed purchases. You definitely want to listen up here because it could be detrimental to your portfolios. And I'm telling you how I'm going to be playing this, what plays I'm making, what plays I'm looking at. Obviously, for me, I'm rarely scared about the market. I look at fear as an opportunity. I've been investing since 2001. Although I started really modestly as a college grad. Yes, I know I'm old, but in 2008 was when I really took advantage of the market. And then in 2020, most of you watching this channel know the type of run up that we saw from the March 2020 crash until now. So I'm going to get into the really important market news segments that you should be on the lookout this week. I'm going to break it down for you exactly what it means. And I'm going to tell you how I would be playing it. Let's get right into it. If you get anything out of this video, leave it a big fat thumbs up. Leave it in the comment section below. Let me know what you think of the market conditions and how you're playing it, and let's get right into it. So as I said, this week, the Fed will be holding their symposium in Jackson Hole, which is in Wyoming. I've actually been there. It's very beautiful. If you have a chance to go, but they're not there for that. What they're going to be discussing is Fed policy in general. Now, obviously, this is going to be couched in terms of the pandemic. Obviously, the Delta variant seems to be raging at the moment. Does that mean more lockdowns, etc.? We are seeing the economy slowing down, whether that's due to the variant, whether that's due to the fact that there was a huge run-up in the GDP after lockdowns were lifted worldwide. Does the Fed consider the economy recovered enough to start tapering asset purchases? So currently, the Fed is purchasing $120 billion in treasuries and mortgage-backed securities. Most of it, though, is in treasury bonds. Now, why do they do this? Well, they do this to keep interest rates low. So here's a really summarized and beginner-friendly breakdown of what treasury purchases look like and why they do it. So let's take the 10-year treasury bond, right? So this means that you buy a 10-year treasury bond, and at the end of 10 years, you get more money back than you put in. So let's say you have a $1,000 bond that you want to invest in. And by the way, anyone can invest in treasury bonds. You, me, whoever. It's not just the Fed. So let's say you have a $1,000 treasury bond, which means in 10 years, it will pay you $1,000. So if you want to buy this today, let's say that you could buy this $1,000 treasury bond for $950. So you buy it for $950, and in 10 years, you get $1,000 back. Well, what is your interest rate? In this case, your interest rate would be 1,000 divided by 950. You are making 5% on your money, or 5.2% on your money. Now, that's rather high. Obviously, right now, we're dealing in the 1% range, but this is just for example purposes. Now, let's say nobody wants this 10-year bond, meaning nobody's buying it. Well, what is the market going to do? Well, it's going to keep pricing these bonds lower. So if nobody wants to buy the $1,000 treasury yield at 950, right, then the market is going to say, hey, what about we sell it to you for 900 in order to entice investors to invest in these treasury bonds? Well, now instead of 5.2%, what are you making on your money if you get to buy this at $900 instead of 950? You are making 11%. Obviously, again, this is nowhere near realistic pricing. I'm just using round numbers for the sake of the example. So that is why you have an inverse relationship between treasury yields and between the price of the treasury. That's why when the price of the treasury goes down, in this case, that means that the interest rate goes up because you are getting more interest if you are buying this thing for 900 as opposed to 950. That's why you see that inverse relationship. Now, why does the Fed come in and purchase these treasuries? Well, Papa J. Powell dictates how many treasuries or treasury securities the Fed is going to purchase. And the reason that they do that is because they want to keep interest rates low. Again, back to this example, if there is no demand for this 10-year treasury at 950, right, then the price is going to drop to entice new investors. However, the Fed comes in and starts buying these treasury securities in large quantities in order to artificially suppress interest rates. Now, they do this in order to grow the economy, because if interest rates start rising sharply, then you'll see stock prices drop, the cost of money goes up, things get more expensive. So in order to keep the economy boosted, in order to curb inflation, the Fed comes in and artificially manipulates the interest rates, not only the Fed rate itself, which has remained unchanged for a very long time, but also the yields, the treasury yields, because those have an effect on interest rates as well. That's the reason why if you try to get a savings account today, you're not going to get paid shit. So this week in Jackson Hole, the Fed is going to make a determination whether the economy has grown at a satisfactory rate enough for the Fed to start tapering or reducing these asset purchases. Now, why does this scare the markets? Because again, when interest rates go up, the cost of money goes up, it's more expensive to borrow money, the value of earnings goes down because now inflation has taken a hit on earnings. Now, there was word that the Fed would start tapering in November. However, in my view, they are going to be malleable according to the news cycle surrounding the Delta variant. If the Delta variant looks like it's going to institute new lockdowns worldwide and in the US, then I think the Fed will not taper until next year because they want to keep the economy boosted throughout the pandemic, especially if the pandemic is going to slow the economy down again. The only reason they would taper is if they feel confident that the economy has recovered and can stand on its own, and they don't need that assistance from the Fed. Now, what has happened historically when the Fed starts tapering? Well, we have data on this. In 2013, the Fed actually started tapering. That wasn't the first time. I'm not going to get into the history of quantitative easing. I will leave an article in the description below because you can actually look at the history of quantitative easing in the United States, but you could see when the Fed started asset purchases and when they tapered and what the effects are. There's a great Wikipedia article on this. However, in 2013, what happened? Yes, the market did see that initial shock. The market did pull back by 6% immediately after the Fed taper announcement, so not in correction territory. However, the S&P finished the year higher by about 30%. Even though the 10-year treasury yield, the one that we were referencing in our example, doubled from 1.5% to over 3%, so a little more than double. And it did that in 6 months, so a relatively short period of time. Now, this has been studied by the Wells Fargo Institute, and you can see here, there's a quote by Chris Haverland, who is an equity strategist there. He said, higher inflation, rising long-term interest rates, and a less dovish Fed could potentially cause a market to pause. He didn't say crash. However, equities have historically performed well through these events, even if there was some initial selling pressure. Now, considering that the S&P 500 index has soared and really hasn't seen a pullback of at least 5% since last October 2020, this could be an impetus for a pullback or even a correction. As I stated before in videos, the only index that saw an official correction, meaning a 10% drop or more, was the NASDAQ. The S&P 500 and the Dow Jones still have not seen a correction after March 2020. And if you look at the PE ratio for the S&P 500, this is actually the Shiller PE ratio, so it takes into account earnings from the previous 10 years. You could see that this is the highest that we've seen since the dot-com crash in the year 2000. So in my view, all of the ingredients are really there for a pullback or a correction if the Fed announces that it's going to taper. Now, if the Fed says, hey, guess what? The Delta variant, we didn't take that into account. Now we have to take it into account. So we're going to shape Fed policy surrounding the Delta variant and the news cycle surrounding the Delta variant. And we're actually going to pause and not make any major changes until we are comfortable saying that the Delta variant is something that is beatable and really won't have long-term effects on the economy in the way that the original pandemic or rise of the pandemic did. So how am I going to be playing this? Well, as you know, I don't believe in being fully divested from the markets, right? A lot of people that I know in, say, 2015, when we saw a market correction, they took their money out saying, oh, this is going to be bad. And they missed 4 years, 5 years of insane gains between 2015 and 2020. Same thing in 2020. I know a lot of people that pulled their money out when the coronavirus talks were heating up, and they didn't reinvest their money until today because, after March 2020 came, April, May, June, July, the market started rocketing up, and it took only a few months to get out of the recession. They were all convinced that it seemed too good to be true and that the market crash was coming. Now it is August 2021, and we haven't seen a market crash yet. So we missed 80%, not we, but people who were fully divested from the market missed 80% gains, even if you just had invested in index funds and nothing else. So I don't believe in trying to time the market from an investment perspective or being fully divested from the market. I still believe in a dollar cost averaging strategy, but I like to put a spin on it. I believe in a weighted dollar cost averaging strategy. So let's say, and this is not financial advice, do your own research, talk to a financial advisor, formulate your own plan. I'm just telling you what I do. So on a regular basis, I invest in the indexes, mainly the SPY and the QQQ. The QQQ following the NASDAQ, the SPY following the S&P 500. These also pay dividends, and what I like to do is dividend reinvesting, so I never withdraw the dividends. Now, I dollar cost average into these, so let's just say that you have a paycheck and you get paid every 2 weeks. Well, you would take a small amount and you would buy into these index funds regardless of what the price is. However, when we do see a correction, and this is where knowing how to read a chart on a rudimentary level, even, you don't have to be a master chartist, knowing how to read a chart will help you. I did a whole video on how to do technical analysis for beginners. You want to check it out here. But when you see that the S&P or the NASDAQ drop by 5%, 10%, you want to take advantage of those levels, and you want to dollar cost average heavier. Again, do what's good for you. Do your own research. This is what I do. So when I see that the NASDAQ drops by 10%, well, instead of playing my typical every 2 week scenario purchase, I go in heavier once I see, especially if it's at the major moving averages, the 50 or the 100-day moving average. It doesn't mean it's not going to drop further from there. It just means that those opportunities are more lucrative than when the indexes are at all-time highs. An industry that I always look for pullbacks on now is the semiconductor industry. Obviously, the chip shortage is raging and has an effect on every single industry. It used to just affect computing. Now it affects everything from appliances to EVs to regular cars, obviously gaming, cryptocurrency mining, rocket ships, airplanes. Literally every single product that you use virtually has a semiconductor component in it. So this is the industry that I always look for pullbacks on. And there is an ETF called SOX, SOXX. This is a semiconductor ETF. Now, it is rather expensive. Currently it's at around $445 per share, but there's some good news. There is a cheaper alternative. It's a leveraged ETF, and it is the cousin of SOX. It's called SOXL, SOXL. This is a semiconductor ETF that trades at 3x leverage, but only costs a tenth of the price. So it's currently trading at around $40. But I buy this on pullback. So again, on the 200-day moving average, I add to it. On the 300-day moving average, I add to it. But I want to look for any pullbacks in this because I do believe that eventually the chip shortage will get solved. And this is actually going to be the biggest market niche worldwide. In the next 10 years, semiconductor revenue is expected to double. I also want to look at undervalued growth stocks. So if you look at Amazon, currently sitting at the 300-day moving average, I definitely dollar cost average into Amazon here, as well as playing options, long-term options like leaps or long-dated vertical call spreads. Amazon is currently oversold on the RSI for the first time since going back to 2019. So this is definitely a scenario where I want to take advantage of owning a blue chip growth stock at a major discount of 16%. Now, I don't expect the Fed to make any major changes in monetary policy, as I said, due to the Delta variant. But if I did expect the Fed to start tapering, well, what I would do is I would buy puts on TLT, because if the Fed starts tapering, that means that interest rates will go up. And remember, there's an inverse relationship between interest rates and treasury prices. So that means that the treasury prices would go down if interest rates go up. So I would buy puts on TLT. Now, I'm not doing this now because, again, I don't expect the Fed to make any major changes due to the fact that the variant is now raging and causing havoc around the world and in the US. But if and when I do expect the Fed to start tapering, then I will buy puts on TLT, expecting it to drop. Before the pandemic, it was trading in a range of 135 to 140, currently in the 150 range. Now, as I said before, I do expect some stagnation or slowdown in the market not everything has to be thought of in terms of up or down. Things can trade sideways. So one of the things that I did when Palantir had a nice run up last week is I sold another round of calls against my shares. These are called covered calls. We sold the $28 call on Palantir last week. We were up 40% overnight on this play. Now, you have to own 100 shares of a stock to do this, but I did this on AMD. I did this on Nvidia. Not that I don't expect these things to go up. It's just that when they've had this run up here and we are expecting the market to actually stagnate due to the fact that there are uncertainties around the variant, there's uncertainties around the Fed policy, then you can sell calls against your shares in order to make money during stagnation or any sort of incremental drop. And if you want access to all of our plays, I send all of these plays out. Link is in the description below. AMD is another stock that I'm looking at individually to buy back into, currently sitting at the 21 EMA. There are obviously very long-term opportunities on travel stocks, especially if travel takes a hit due to the Delta variant. You do want to look at like the Jets ETF or some of the cruise lines. I mean, these are not going to be lucrative likely for a very long time. But if you have money set aside and you want to invest it and you don't want to look at it for another 10 years, then these are stocks that will likely, in my opinion, be higher in 10 years than they are today. You just have to exercise patience when investing in these things. I'm not talking about trades here. So that is what I'm doing. In summary, I'm doing a weighted dollar cost averaging strategy where if we do see a major pullback in the indices, I will invest heavier than I do now. The semiconductor industry specifically is what I'm looking at for pullbacks. Look at AMD, look at SOXL, look at SOXX. If and when you do expect the Fed to taper, you can look at buying puts on TLT, which trades inverse to the Treasury interest rates. I think the travel stocks present a good, very, very, very long-term opportunity here. This is not something that will likely boom in the short term. And look at things like selling covered calls against your shares. Obviously, you could do things like buy puts on the indices, buy put spreads, etc., as protective measures here or as hedging strategies. And if you want access to all of our trades, link is in the description below. I hope this video helped you. Keep your eyes on the prize. Be on the lookout for these news cycles that I described. Be on the lookout for these economic factors that I described. If you got anything out of this video, leave it a big fat thumbs up just like this. Leave it in the comment section below. Let me know what you think of the current economic conditions. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.